Hey everyone! Today we're diving into something that feels like a black box for most startup founders. How in the world do you put a value on a company that doesn't have any revenue yet? It's a total puzzle, right?
But stick with me, because by the end of this, you're going to have the key. Let's jump in. For so many of you out there, this is a real head scratcher. You've got this amazing idea, maybe even a working prototype, but zero sales. So what's the price tag on that? The numbers you hear thrown around can be, well, all over the place. I mean, this is the core of the whole thing, right? You see one startup, no real product yet, and they raise money at a $1 million valuation. Then you see another one, looks like they're in the same boat, but they get $100 million. Like, how does that even happen? Is someone just throwing darts at a board? Well, no, not really. Okay, so before we get to what actually works, we gotta talk about what doesn't, and trust me, there's a long list. So many founders walk into a pitch with these super complicated, fancy-sounding valuation models, thinking it'll blow investors away. Spoiler alert, it almost never works. So picture this. There's this founder, let's call him Jim. Someone asks him, hey Jim, why is your company, with no product and no revenue, worth $200 million? And his answer? Because we're going to be a unicorn. You gotta love the confidence, right? But yeah, that's the first method that completely bombs. And this is super important to get. Investors don't value your dream, they value the potential return on their investment. Think about it. If they agree to a $200 million valuation, they lose money on any sale less than that. And guess what? The vast majority of startups sell for way less. It's a huge red flag for them. This really shows the two different worlds, doesn't it? As a founder, you're selling this incredible, world-changing vision. But the investor? They're looking at a spreadsheet. They're doing cold, hard math. They're not buying the vision. They're buying a percentage of your company. And that percentage has to be big enough to make their whole fund profitable. And it's not just the we're going to be a unicorn approach. Oh no. Founders pull out all the stops. They find these methods online. Discounted cash flow, which is basically making up future money you don't have. And then there's the Berkus Method, the Scorecard Method. You can go Google them if you want, but honestly, save yourself the time. Because here's the stone cold truth. You could spend weeks making the most perfect, beautiful financial model, and investors just don't care. For a company at your stage, they don't use these methods, period. Bringing it up in a pitch, it's just a waste of your breath and their time. All right. So if all that stuff is wrong, what's the right way? Well, we're about to pull back the curtain and show you the surprisingly simple formula investors actually use. This is going to be your aha moment, I promise. It all boils down to one thing: investor portfolio math. See, VCs are playing a numbers game. They know most of their investments are going to go to zero. Poof, gone. A few might do okay, but they're banking on one or two being absolute monster home runs. Think 10x, 30x, even 100x their money. And for that to work, for the math to make sense, they need to own a specific slice of every single company they back. And here's what that looks like in the real world. At the super early seed stage, an investor is shooting for about 10% of your company. Why 10%? Because that's the ownership they need for a potential 30x plus return to make sense for their fund. Later on, at Series A, that target might jump to around 20%, maybe for a 10 to 30x return. See? It's all about their math, not yours. So the big thing to remember here is that this isn't some kind of abstract art. It's not a debate about your 5-year projections. At this stage, it's just simple mechanical math. That's it. It's driven entirely by their need to hit that ownership target. Okay, let's make this super concrete with a quick example. Let's say you're out there raising a $100,000 seed round. And that investor you're talking to, based on the math we just went over, they've decided they need to own 10% of your company when the deal closes. So, how do you get the valuation? It's just the formula. You take the investment, that's the $100,000, and you divide it by the ownership they want. That's 10%. And voila, you get a $1 million post-money valuation. That's the value of the company right after they put the money in. It really is that simple. Okay, so now you're in on the secret. You know the math they're doing in their head. So what do you do when they hit you with that question? You know the one. So what valuation are you raising at? Here it is. This is your number one go-to answer. I'll let the market decide. And who's the market? They are. The investors. It's a super polite, super professional way of saying, You tell me. It puts the ball right back in their court. I mean, this is negotiation 101, right? Whoever says the first number is at a disadvantage. By letting them go first, you get a ton of info, you get leverage, and you don't risk shooting way too low or accidentally scaring them off by aiming for the moon. But of course, a smart investor is going to push back. They'll say, come on, give me something. You gotta have a range in mind. So what's your play then? You gotta have a plan B. This is where you bring out the one method they actually do respect, looking at similar deals. You can say something like, well, from what I've seen, companies kind of like us, at our stage, have been valued somewhere in the X to Y range. This shows you know your stuff, but you're not locking yourself into one number. Okay, we've gone through a ton. We've debunked the myths, we've seen how the machine actually works. So let's boil this all down into a super simple playbook you can literally start using today. It's just 3 steps, really simple. 1, ditch the complicated theories. Seriously, just throw them out. Investors don't use them. 2, get that it's all about their math. It's mechanical, and it's all about their ownership target. And 3, let the market speak first. Let them make the first move. That's your power play. So there you have it. You get the mechanics now. Valuation isn't some secret dark art. It's just a formula. But that brings us to the real question, the most important one. Knowing the formula just gets your foot in the door. The real challenge is building a business and telling a story that is so compelling, so exciting, that an investor looks at you and thinks, yeah, this is the one. This is the one that's going to give me that 30x return. So the question isn't what the valuation is your story worth the risk?